Hi everybody, my name is Randall Morrow with Resin Investments. And today we're going to talk about real estate syndications. Specifically, what are they and what they look like. I'm going to describe a typical deal from a financial perspective, from the investor's perspective, if you will. You'll hear many different terms for this type of structure. You might hear real estate private equity, obviously real estate syndication, real estate limited partnership, real estate crowdfunding. There's a whole bunch of different terms for this, but essentially they're the same thing. Basically what it is it's a company that is formed for the purpose of investing in a real estate deal. And the structure is set up so that you have one party kind of in charge, and they are called a general partner. And their job is ultimately to find the property or properties you want to invest in, to set up the legal structure, to actually run the day-to-day once the property is purchased, and ultimately make it profitable. The other party in these companies is the investors, and there are many of them. They are called limited partners. And what a limited partner essentially is that you are limited in your liability, in the damages that can happen to you in this corporate structure. So for you, your one and only one job is to provide the money that this deal is going to use in order to buy a piece of property. Once you've done that, your job is essentially done. And from then on, your job is just to hopefully collect checks. It's very passive. There's no day-to-day work in any capacity. In fact, it's essential that you stay removed as a limited partner, because if something bad does happen, and to use an example, let's say in an apartment complex, someone falls down a flight of stairs, ultimately their family sues the property management company for some huge amount of money. In that scenario, your only risk as a limited partner is the initial investment that you made. So if you invested $50,000 as an example, and this person was suing the company for $10 million, literally the worst case scenario for you would be you would lose your $50,000 investment. And obviously that's a terrible thing. But when you're looking at multi-million dollar pieces of property, I find it very, very helpful to know that my liability is capped, that I don't have to worry at all for any legal problems. So what type of real estate can you invest in? If you're driving down the street, look around, and most likely all of those are investment possibilities. They can range from multi-family apartment buildings to office buildings, medical buildings, industrial buildings, self-storage units, mobile home parks, and even single-family homes as well. All the deals essentially work the same way, which is you invest, the company then purchases something. And again, it could be multiple properties, but they purchase something. And then for a period of time, they run that investment. I want to describe a typical deal just to kind of help you with understanding how they work. So a typical deal is generally between 3 and 5 years in length, and a very good example is an apartment building. So let's say that there is a 300 unit apartment building that was maybe built 20, 30 years ago, is in need of a little bit of love, and they're selling that property for $10 million. So a typical deal would be, we're gonna buy this property for $10 million. Along with it, we're also gonna put in $3 million in renovations. And that can be everything from making the interiors more enjoyable, like putting in granite countertops or higher end amenities inside the actual units. But it also can be, we're gonna put in new equipment in the gym and make the pool area much prettier, as an example. Most times you know ahead of time, before you enter into the deal, what the plan is. But ultimately in that scenario, you as the investor, the group of investors have put in $13 million into a $10 million building. And so during those 3 to 5 years, what occurs? Generally in year one, it's what's called value add, which is during the first year, the company is renovating the building. They're focused on getting that building up to snuff, to improve it, ultimately to make it more valuable for potential renters and essentially, eventually, a potential buyer of the property. So that first year, they're just hustling with construction. In years 2 and 3, generally what you're doing is called rent stabilization, which is essentially, now that we have this beautiful building, we first off want to charge more in rent. So we're going to raise the rent of our existing tenants. And secondly, we want to make sure that every unit is rented. Many times in these older buildings, there will be some vacancy. And so we want to get those filled up. And then in years 2 and 3, we want to show a consistent rent flow. We want to ultimately show that this place is generating more income than when we first bought it and more valuable to a potential buyer. And at the end of that time, then we start looking for sellers. So someone is going to be interested in buying that property, and that can take a few years depending on the market conditions at that moment. From an investment perspective, as an investor, how does that same thing look? Generally, the minimum investment for these types of funds is $50,000. So on day one, you're putting that money in, and obviously they are using that money to fix the unit, to add value and run the operation. In years 1, 2, and 3, as an investor, usually you're set to receive what's called a distribution, which is ultimately the company is receiving rent from those tenants in the building, and they're passing that income to you. So you're receiving some amount of money on a quarterly basis, and usually it's around 8% a year. So figure 2% of your original investment every quarter comes in. Now that's not guaranteed money, but it's pretty likely. And in a future video, I'll give you specific examples from when COVID occurred, how certain funds actually held back money just for safety reasons. They wanted to build up their cash. And once that concern of COVID was over, then they caught up. They paid not only the current distribution, but they paid prior year distributions as well. So while you own the property, you're receiving a steady income. And then ultimately at the end, you get the final payday, and hopefully that's a good one. So when they do sell the property, obviously you get your cut, and the sponsor or the general partner gets their cut as well, and the deal is done. During that time, you can take advantage of the tax benefits of the company. Because you are a partner in the fund, you receive any of the tax benefits related to it. And specifically, depreciation is the big one, where in those first few years, you are receiving checks, but yet on your taxes, it shows that you've made a loss from an investment perspective. So these are fantastic opportunities for high income W-2 wage earners where you need write-offs, because you're making money, you're getting paid every quarter, but yet on your taxes you're showing big losses. So hopefully that explains in a nutshell what a real estate private equity deal looks like. I hope this helped. Stay safe out there in the investing world. Take care.